Hey guys, welcome back to another video. So as you guys have seen from the title, this is a collab between me and Stoic, and we will mainly be discussing about data and fundamentals and how it can help you as a trader to become better. So Stoic, you may introduce yourself.
So I'm Stoic, mainly from the YouTube channel Stoic Research, where I more or less discuss macro fundamentals, using fundamental data. And now I more or less started as a trader, as anybody else, where I just simply traded stocks. I've pretty much traded for 8 years. So I have 8 years of experience now, which is pretty crazy because I'm only 19. So I started when I was a kid, more or less. So that's pretty crazy. You might know me because I'm also on TikTok, also on Twitter, but mainly I would say my main focus is now on the YouTube, like overall. And that's just simply because I like showing a lot of data, a lot of stats. I like to be unbiased. I like to be, professional rather than pretty much a social media guru. All right. And that's just simply how I came to be, right? Now I transitioned from just simple stock trading to more or less trading, I guess, crypto. And then essentially I went into trading foreign currencies, foreign exchange rates. And that's more or less where my area of expertise, I would say, is. But I trade everything from essential stocks and short term. I don't scalp because I really suck at scalping, but I trade short term, intraday mainly. And then, of course, I invest long term as well. And that's also something I've mainly been focused all throughout these periods. So I have essential 8 years of experience investing as well.
How do you efficiently validate a strategy for data collection to exploit probabilities?
All right, so like I previously said, right, what's important to note here is simply that, as I said, concepts does not make you profitable. Actual data collection makes you profitable. And actual, as I said, like you need to create a step-by-step process from these concepts. That's what's the most important thing, right? That's the one thing you need to focus on. You need to select some concepts you like. Now, personally, I data test them as well, so I actually see that they have individually some edge alone. But listen, they don't need to have an edge alone, right? You can combine them to create an edge, like for example, ICT concepts, etc., and all of that. Now, what's the most important thing is data collection. Now, you can see I collect data on majority of the things I do. I collect data on, for example, the biases I have, both quantitative and qualitative data information. So you can more or less, if you just go in here, you can see I collect a lot of freaking data here, and I collect scores, my quantitative C-scoring, etc., etc. I collect that on every single little thing. But you can see specifically for example, like my different execution models. And this is overall a step-by-step process. Now, you might be trading, for example, ICT concepts or whatever, right? Now, you have a step-by-step process. How you validate it and how you create it and actually make sure it's a real edge is that you start by checking this step-by-step process. I would start by back testing or forward testing it, or even testing it. The best way is to test it in of course, TradingView. You can create different strategies on TradingView, plug them in, and then actually see the ultimate quantitative and qualitative information of that strategy, and to see if it actually generates a profit. But then yet again, that takes away the discretionary part. So then it's just fully on quantitative and fully on more or less implemented on the charts, right? You maybe want to have some qualitative and discretion into it, right? Which you won't be able to do if you just have a full-on quantitative edge, right? More or less, they have like a full step-by-step process, which is quantified, right? Fully quantified. Now, personally, I mix a little bit of discretion, but my primary model, which is I have different execution models, but they're fully mechanical, meaning they're fully step-by-step process. Now, on those and how I turn them into an edge, because I cannot talk about some other edge and essentially if I was to do it again. Rather, I was just gonna more or less talk about what I've done to create this as an edge, right? And I've just collected data on the individual processes, right? So on the individual executions. And since it's a step-by-step process and it's mechanical, it's the same thing over and over again. So I've just simply collected data on this to simply validate it. Now, because of course, in the beginning, it won't be profitable. It won't generate, it won't make you money. It may very well do so, but it's a high likelihood that essentially it won't enable you to make any money. So that's why it's the best thing to start with, prior to you going to a live account or funded account or whatever, right? But how you do it, because you could say the markets is, I see the markets, at least because I need to be a little bit more, specific, right? With what I say. I don't say everybody looks at the market the same way as I do, but at least I look at the market as a generalized market and not a very individualistic, right, approach. So what I mean by that is that the markets is more psychological than scientific. Now that might sound strange, all right, because nevertheless I am a macro trader, but what I mean is that you cannot mathematically say, like in terms of math, right, the markets is probabilities. You cannot say in accordance to 100% probability where the markets will go. So there's not a mathematical formula to explain the next move in the markets. Rather, it's based on other people, I would say moves, what other people does. And so it's more psychological. And in psychology, right, what people explain is that you cannot specify anything. You can generalize, however. So you cannot explain what one person will do if they go through trauma. But you can see what majority of people will do if they're put in that situation. Similarly, the markets, you cannot say what one singular day will do. But if you have data, you can say what that day will do most likely. That's what I mean. And a similar thing goes with data collection, right? Where ultimately you should collect data, and when you have the data, you should not look at one individual trace. And this is what data collection is different from journaling, because journaling, you go back and you look at your mistakes you did, discretionary mistakes. Through data collection, you're not looking at discretionary mistakes, rather you're looking at a process mistakes. So you're looking at, rather than one individual traits, you're looking at multiple similarities between multiple losses and multiple wins. And then you look at what is the simple similarities and the differences between these losers and these winning traits. And then you look at all winners and all losers, rather than just an individual loss and an individual win. That's literally how you create an edge. So hopefully I said it. So I'm just going to repeat myself once again, but just write like 1, 2, and 3. That's the 3 simple steps for you to actually gain an edge from just individual concepts alone. Number 1, understand that concepts just give you information from candlesticks. That's literally all it gives you. Number 2, what overall you need to do is understand that and create a step-by-step process from these individual concepts. Number 3, you need to collect data on your edge, which you have created, which is a step-by-step process, a mechanical edge, right? Now, understanding that, you need to look at the data, look at the similarities between the winners. That's how I knew I was going to focus on, since I explained in the beginning. I was more or less forced to become more macroeconomical. I was forced to look at more fundamental data. That's just because I more or less underperformed during a specific period in my edge, because let's say it's mechanical. I've always had some external, I would say external factors on it. And what I mean by externals is fundamental factors. But I needed to specify those fundamental factors, meaning go in and quantify them to me or for me to actually become a better trader and be able to execute on my model better. So that's literally it. And how I came to that realization, I just might add, and how I came to that realization was because I noticed in the data that the similarities between my losers, because you look at all your losers, was simply because I lost on a day I was biased in my head, because like I said, I did it discretionary. So I looked at fundamental data. Like I looked at fundamental data, discretionary, meaning I just looked at the data trends of the fundamentals, rather than me like quantifying the fundamentals and actually getting an unbiased opinion. Because if you quantify and get C-scores, etc., you can look at historical averages. So you can actually see are we above this historical average, and where we're actually trending to, because you can also quantify trends in fundamental data points. So that's what this forced me to do, because like I said, the similarities between the losses told me that I was biased in the way I looked at, like I said.
So, Stoic, how do you look at news objectively? Meaning that, as people do, right? They read news articles, things like that. They get a subjective view in their mind and then they use that to trade. But I want to know how you can use statistics of fundamentals in order to find an objective way of looking at it to influence your trading.
So what I always start doing, and I'm going to give you a real-time example of this, is that I break down the question, all right? Or break down the, fundamental I get. Like, for example, recently we had the sentiment shifted towards people actually betting that, Marcus was an AI bubble, all right? Now, how I came about and how I usually research these individual topics is that I break them down, and it's quite a long process. But what it always starts with is that essentially I always look at ultimately how it relates to fundamentals or macroeconomics in this case. So I always break it first of all down to how it relates to macroeconomic cycles, okay? Now here we have business cycles, all right? Now business cycles is what more or less all people should ultimately focus in on if they're trying to understand when we're going to have these collapses and or expansions in Nasdaq prices, right? Since they need to understand where we're currently at in this business cycle for them to understand if we're going to have a crash and if we're actually going to go into an overheating cycle in which multiple people were, saying we were going into this AI bubble, or that the AI bubble had just bursted. And this, of course, happened when Michael Burry took the short. And of course, I actually ended up betting against him. So I'm pretty bullish on Nasdaq. Now, how I came to that realization is simply that I, first of all, broke it down subjectively, right? So I focused in on how is this actual impact on the markets? How does this impact the markets? Why does this impact the market? And of course, it relates to, the growth cycle, etc., etc. And so I focused in on the growth cycle, focused in on the economic cycle. And so essentially, I broke it down from there as well. So then I went in and looked at, for example, housing sector, because essentially housing sector is what ultimately is most related to the business cycles in this case. So if we're seeing a slowing business cycle, or at least seeing, where we're at. So if we were in overheating, which multiple people suggested we were in, we would actually, in fact, see the housing sector being crazy. We would see it being overheated, right? But what you can see here is that it's just consolidated. This is the housing market. This is the total housing market in the US. And it's not going crazy at all. Rather, it's actually the underlying economy in the US is actually slowing down, and I would even suppose it's in a recession currently, while the only thing keeping the US out of recession is, of course, the AI boom, which is actually happening. And people suggested that was an bubble, right? Ultimately, that does not answer if it's a bubble, because, you need to compare it to other factors which has previously happened. So then you can look at other sort of information and other sort of data which relates to other times we have been in a cycle or in a bubble. So then essentially you can compare it to other events in which we have been in a bubble. So I just looked at ultimately what happened in 2000, where we were currently at for example fundamental factors, but also macroeconomic factors, but also just pure financial stock factors, right? So, such as which PE ratio we were trading at when we were in the dot-com bubble, and of course we were trading at a much higher multiple back then than we are at currently, which means that markets is definitely now overheating. As I showed you, the macroeconomic state in the US is pretty consolidated, meaning it's not going through a bubble. For us to be in macroeconomic bubble or a technical macroeconomic bubble, we need to have leverage in the system. We need to have companies borrowing money. So if they borrow money, they're not going to do it, of course, in high interest rate period. And we, of course, are in a high interest rate period. So it does not at all align with it. And if you just go back, everybody in watching this video right now, to the business cycle picture I showed you, the economic cycle, and actually pause there and read what the typical signs is of an overheating period, you'll see that it does not at all relate to the macroeconomic factors we're going through. People are currently going through the worst times of their life currently, like average day people. Now, that does not necessarily correlate to markets going down lower, but in a normal stance, it should. Okay. Now, why we have pretty much not gone through that is, as I said, because we're not overheating. Rather, we're just finding a bottom, and it's just going to get better from here. And the market is just essentially, relying on the money poured into the system. Now, think of the macroeconomic factors. When the Fed has cut to zero, money is just going to continue flowing in, which is why I'm that bullish. But let's just go back to essential data, comparing this period to the dot-com bubble, which a lot of people were actually comparing it to. As you can see, cap expenditure is also still growing. And of course, this is like financial. This is not so much fundamentals. This is just comparing different factors and actually breaking it down to, as I usually say, physics principles, where I go through and compare different historical analogies. So these are not macroeconomic, but you could say this rather fundamental, breaking it down to principles, as the question stated. Ultimately here, you could see this is a real-time example. CapEx is still growing here. Like currently, you can see 2025 is growing, while here it was totally collapsing from 2001, right? As you can see. Similarly here, the 7 biggest tech stock was trading at a much higher multiple, a much higher PE ratio back then than they are currently. Currently, they're trading at a, more or less historical average. So if you just plot on standard deviation on this, which is of course a more quantitative way of looking at it, we're actually traded in like the mid-range, which is where we're at like 80% of the time. And so if we were to an overheating period, and I'm actually going to show you the standard deviation here, since I think that's, leading to a much better perspective on these things. And then I'm going to talk about like why I showed you this specific event, but there's of course for 2 given reasons, and I could actually even discuss it currently. So number one, it's simply because ultimately it's a very recent event, and second of all, very wide spoken event. So it's just what people would call fundamentals. And of course, I'm just showing, as the question stated, how you break it down. So you can see I actually, in fact, look at real data. So you can see here, it went over the 5-year standard deviation. This was, of course, back in the 2000s. And the overall, this is Nasdaq's PE ratio, which is not really macroeconomical or fundamental in any given way, but it's more financial. It's more, I would say consider it fundamental, but it's not macroeconomical. And nevertheless, you can see traded at like a 71, PE ratio, because overall the EBITDA or EBITDA more or less collapsed of the individual companies. That's more financial or fundamental. So they were trading at a crazy historical PE ratio. CapEx more or less went down like crazy, simultaneously as the macroeconomical, because back in the 2000s we actually see an overheating cycle macroeconomically, like looking at these individual fundamentals, which ultimately led to this ultimate bleed on the economy, which then bled into the stock market. Right now we have already gone through a bleed in the economy, and the economy is slowly recovering, and that's just a macroeconomical way of stating that it's just way more possible for us to continue higher and actually continue bullish for the next 5 years until the Fed actually raises interest rates for its next overheating cycle next time. So now they're cutting cycle, I guess. Well, at least my data suggests so. But ultimately, in the very near future, right, when they actually start their hiking cycle yet again for an overheating economy, that's when you possibly will look for collapses. But the data here for the individual financial company, like P ratios, etc., also suggest this. So that's how I break down fundamentals. I actually go into what actually is the historical analogies here, and then break it down from there. All right, that's just an whole. I call it like long-term horizon analyses. But this is not what I do for like small macroeconomic events, but that's how I look at it subjectively and objectively, rather than like discretionary. So I actually in fact go into the data and look at the data, and I do some quantitative and qualitative research on it, rather than just stating what other people are saying. Hopefully that answered the question good.
Okay guys, hopefully you guys like that segment between Stoic, and you guys saw how he looks at the market objectively with fundamentals, and how he collects the data with like, qualitative and quantitative data, right? And you guys should start to understand how to collect your data a bit more in depth. What I will teach you right now is an advanced risk model called asymmetric compounding, right? And this risk model can literally double your profitability with the same stats you have right now. We're literally just changing your risk model, right? So here you can see that we start with 10,000, right? And our win rate, the probability of us winning after 100 trades is 33%, and we are risking 1% in order to make 3%. So our RR is a 1 to 3, right? And if we run this 100 trade simulation, a Monte Carlo simulation, then our max consecutive losses will only be 10. We're losing 10 times in a row, the max that we're going to lose in these 100 trades of the simulation, right? And within this 100 trades of the simulation, we're going to consecutively win 4 trades in a row, right? Now, if we do regular compounding, meaning that we just risk 1% statically every single trade and we make 3%, our account would be up $3,000, right? However, if we do asymmetric compounding, which I will teach you, then we can literally double our account, right, by just doing asymmetric compounding. So first of all, what is asymmetric compounding? Asymmetric compounding is when you are dynamically risking based off your winners and losers per trade, right? And you're going to be risking differently, dynamically, every single trade. So let me give you guys an example, right? Okay, so let's say in your first trade, right, you win. So with the 1 to 3 example, right, your 1 to 3 risk reward ratio, you're risking 1% in order to make 3%. So your first trade, you're risking 1% and you make 3%, because guess what? You won this trade, right? Now in the total PNL, right, you are up, let's say, now in this example, you're up 3% in total, right? So you're up 3, or now let's say in the next trade, you win again. So what the goal of asymmetric compounding is that you risk your earnings plus your original risk. So you're risking 3% plus 1%, which is 4%. So now you're risking 4%, right? And if you win this, right, now you're making 12% on the account. And in total, right, if you do 12 plus 3, that means in total you're up 15%. So if you literally just win 2 trades in a row, 2 to 3 trades in a row, you're going to be basically passing a prop firm if you're trading a prop firm, right? And the challenge, like example to like pass an account is 10%, right? And the only worst case scenario, right, is that if you lose the 4%, right, that you risk in your first trade, you're only going to be down. So you're going to be up 3%, and if you lose, right, you're only going to be down negative 1% on the total account balance, which is not bad, right? You're technically having an example of you're up 3%. Would you want to be up 15%, or would you want to only be down negative 1%? Right? So you can see that the reward is much greater than the loss. That's why asymmetric compounding is very, very good in terms of that it can double your profitability in terms of your P&L, right? And it can cost your evals, your get payouts within a couple of trades, right? So now let's do another example, right? So after you make your 15%, right, you want to revert back to 1%, right? So after you win 2 trades, you revert back to your original, right? So your original now, let's say it's 1% you're risking, and you lose, right? So now you lose. You're going to be losing 1%, right? And after that, you're only going to be up 14%, right? And then let's say in the next trade, you win, right? So now you're risking 1% in order to make 3%. So now 14 plus 3, right, is 17, right? So now you've made 17% on the total account balance, right? So now what you want to do, right, is you do 3 plus the 1 is 4. So you're risking 4, right? And if you make 4, you're making 12%. Now if you do 12 plus 17, which is, now you're up 29%. Do you see? So after 1, 2, 3, 4 trades, you're up 29% because of asymmetric compounding. So what are the rules, right? The rules is that you want to win 2 trades in a row. That's when you risk your original risk plus your winning risk, the risk that you've just won, right? And then whatever money you make from that, you go back and you revert and you keep on going in the cycle, and you'll see your PNL starting to look like this, right? So you go up, let's say you lose a trade, but then you win 2 trades in a row, you double it, right? And then you lose, you double it, you lose, you double it, like that, right? So that's how your PNL is going to look like after asymmetric compounding. It's very inconsistent. You're going to have these bumps, right? But that's why you have to make sure and you have to trust in your edge after you data collect. So guys, remember that this is very psychologically difficult as well. It will play with your mind and things like that, because you're going to be down and then you're going to be crazy up, and then you're going to think that, oh, I have so much leverage now, I'm going to risk even more. I'm not going to be risking 1%, I'm going to be risking 2%, because then I can double my profitability even more. Don't do this, because if you do this, psychologically you're going to feel unwell and you're going to lose even more, right? And you wouldn't want to do this. And in my testing, I've seen that this will actually help you even more to passing your accounts, to, you know, making to the payout stage even faster, to getting funded even faster. The only thing that you guys will have to do, right, before doing this asymmetric compounding is by actually data collecting, right? How Stoic said, you need to data collect, right, in order to know that your strategy is good, in order to know that your edge is actually working in the market. Then you're confident, then you can actually asymmetrically compound, right, and use this advanced risk model. So yeah guys, so if you literally just get an eval, right, from a prop firm, you can literally pass an eval within 2 trades. That's all you need to do. But you need to make sure that you have the data to back up that your model actually works, right? And what is the win rate of your model after 100 trades? What is the average risk to reward ratio? Then you know, then that's how you can exploit asymmetric compounding. Well, anyways, I hope you guys liked this video between me and Stoic, and you guys will actually use some of this stuff like asymmetric compounding or even the fundamentals and things like that, right? And this will greatly help in your trading to become a better trader and become statistically better as a trader, right? And I will have a Notion, the notes of all of this, right, because this is probably a really long video. So I'll have it in the pinned comments or in the description, a Notion with all the notes about this video, and you guys can read over it, the summary. If you missed anything, it'll be there in the notes. And yeah, if you guys want to join my Discord, you can ask me any questions about this and I'll answer you guys in DMs or in the server as well. So if you guys want any more content like this, make sure you guys comment and let me know if you guys have any other ideas or if you have any questions about the video. And yeah, that's it.